How can you avoid dividend yield traps? Imagine finding a stock that promises a very high dividend yield. It seems like a great way to boost your income, but sometimes it's a warning sign. You might be looking at a dividend yield trap. This happens when the dividend looks attractive, but the payout isn't sustainable. Usually, the stock price has fallen sharply because the company is facing problems. So, the high yield is actually a red flag, not a bonus. To steer clear of these traps, start by understanding how dividend yield works. It's calculated by dividing the annual dividend per share by the stock's current price. When the stock price drops, the yield goes up. But if the company's fundamentals aren't strong, that high yield could be a sign of trouble. It's not just about the number, it's about what's behind it. Next, look beyond the yield. Check if the company can keep paying dividends. One way is to look at the dividend cover ratio. This is the company's net profit divided by the total dividends paid. A cover of 4 or higher shows the company earns enough to comfortably pay its dividends. A cover between 2 and 3 is okay, but below 1.5 means the dividend might be at risk. If it's below 1, the company could be paying dividends from reserves, which isn't sustainable long-term. It's also smart to review the company's financial health. Look at its earnings, cash flow, and debt levels. If earnings are falling, cash flow is weak, or debt is high, the company might struggle to keep paying dividends. For seniors relying on steady income, sticking with companies that have stable or growing earnings and strong balance sheets is safer. Don't forget to examine the company's dividend history. A long streak of paying dividends is good, but it doesn't guarantee future payments. Market conditions and company health can change quickly. Focus on companies with a history of consistent or increasing dividends and positive future prospects. Be cautious of stocks with sudden dividend yield spikes. These often happen because the stock price has dropped sharply. Always investigate why the price fell. If it's due to fundamental issues like declining earnings or high debt, the dividend could be cut soon. Diversification is key. Instead of putting all your money into one stock, spread your investments across different sectors. This way, if one company faces trouble, your income isn't wiped out. Combining dividend stocks with other income sources like bonds or annuities can also provide more stability. Finally, look ahead. Instead of just focusing on the current yield, consider the company's future earnings and dividend payout plans. This helps you avoid being misled by temporarily high yields that might not last. For seniors, avoiding dividend yield traps means focusing on safety and reliability. Do thorough financial checks, monitor dividend coverage, and choose companies with solid earnings and cash flow. This approach helps build a dependable income stream and reduces the risk of sudden dividend cuts or losses.